Welcome everyone for another Real Turkey episode. We'll be having our regular guest, Mr. Atilla Yeşilada, and me, Güldem Atabay, as our host, and we'll be talking about Turkish economy, which seems to be going through a very happy period right now, right after the central bank's hefty rate cuts. But the problems mainly start with Attila is that while the economy seems to be, or Lira seems to be rebounding from its losses that were staged since the start of the year, and the government was betting on the continuation of economic recovery, it seems to be that the July confidence indices are down again. And what we're seeing is that after the rate cuts that the central bank has delivered, 425 basis points, which was beyond expectations, which centered around or averaged to 250 or 300 basis points. Turkish lira is recovering. Turkish treasury yields are coming down. The CDS risk premium is coming down as well. So at one side, everything seems rosy, but the real sector is not functioning with the same pinkish environment. So what's really going on in the Turkish economy? What's the confidence indices showing why the markets are reacting in another direction? What's the main theme behind this?
Well, let's start with data. I'm really surprised in a negative sense. I had expected a rebound throughout the summer, but the sectoral confidence indices from June, which cover retail, construction, and services, are miserable. Construction recovered somehow, but from 50 to 52 points, whereas normal is 100. Both retail and services declined. I also looked at forward-looking indicators like how much business volume do you expect in the next coming 3 months. Those two indices sub-indices have also declined. Consumer confidence is down in July by 2 percentage points. Uh, Manufacturing sector confidence is down. Manufacturing total orders for the next 3 months is down. Manufacturing capex intentions is down for the next 3 months. To me, that's a confidence crisis. When the currency is so strong, or at least not weakening, when there is good tourist flow, and apparently everyone should be making a good turnover, the fact that no one has confidence into the future suggests that there is something deeply structurally wrong with the economy. I believe it's that no one trusts the presidential system anymore, or that everyone expects the system to change and can't forecast how it will be changed or what will replace it. Another sign of ultimate lack of trust in the economy or the future is, of course, dollarization. In the last data week, Turkish retailers and corporates have purchased $1.1 billion. So FX deposits now constitute 55% of the total deposit base, which makes running monetary policy very difficult. On top of that, as you said, the central bank rate cut came, 425 basis points, the big bazooka approach to stimulating the economy. I want to make something clear. Central bank doesn't make monetary policy in Turkey. It's Mr. Erdogan who makes monetary policy. Mr. Erdogan also provided forward guidance for monetary policy in his recent statements. He said the first round of rate cuts is good, but insufficient. He expects more steps. I look at market expectations they range anywhere from 200 basis points until the end of the year, all the way to 500 basis points. Knowing Mr. Erdogan somewhat, he being my beloved leader for the last 20 years, I would suggest he would plump for 500 basis points. So, rates are coming down substantially. The question is, first of all, would that help the real economy? To me, they won't. Not for long, maybe for a month. The reason is, as soon as central bank cut rates, Turkish banks cut their TL deposit rates. The average TL deposit rate right now is 8.5%. and headline inflation is something like 15%. But unfortunately, this number has no credibility. I am not claiming Turkish Statistics Agency is tampering with the numbers, though some do. I am claiming that people, the Aisha, the Esra, the Ahmad on the street, thinks inflation is something like 20%, maybe 25%. You can read that in the social media. So to them, the ex-ante real rate on TL deposits is negative. Therefore, there is no incentive for Turks to stay in TL deposits. I am really afraid of an accelerated escape from the Turkish lira. Of course, if banks can't raise Turkish lira deposits, they can't make Turkish lira loans because the corporate sector, having been burned so many times, doesn't want FX loans. And taking FX deposits and swapping them in London is difficult simply because Mr. Berat Albayrak, in his infinite wisdom, shut down the swap market right before the elections, which elevated the risk premiums. And as we put in our Turkish website, swap volumes are substantially down. So I think banks rushed too rapidly into this deposit rate cuts, which would backfire. Loan rates might come down for a month or two, but I don't think loan volume is going to accelerate because there's another problem here, which is that the risk perception from the bank's viewpoint is extremely high. Over the last week, we have seen a very large furniture company in Kayseri seek Chapter 11 protection. It has 300 branches. And a construction company in Antalya, which is currently the most booming city in Turkey, also go for bankruptcy protection. There is really no effort to work out the bad loans or distressed loans in the bank balance sheets. So I don't think banks are going to be extremely interested in making too many new loans. And Turkey being so credit dependent, I don't expect a significant stimulus effect from the central bank rate cuts. Now, the currency stability, it has several reasons. The first reason is very interesting. Foreigners don't care. There is no foreign money left in Turkey. There is some in the swap market, for carry trade, but all the real money that I have contact with doesn't want to touch Turkey with the 10-foot pole as long as Mr. Erdogan runs the show, as we have indicated many times. The second reason is that since we can't import, we don't have any current account deficit. So there is a current account surplus, which means cash is coming in. Three, this is the dead season for bank rollovers. That's for foreign financing requirements. So no money is coming out. And finally, of course, Fed. There is this, it goes beyond expectation or beyond a projection. There is this belief, almost religious belief, that American economy is on the verge of a recession and Fed will not only cut 25 basis points on 31st of July, but it will continue cutting until there's nothing left in the salami. So, even if there is not too much hot money in Turkey, at least none that's in Turkey is coming out. I mean, I should mention there is still roughly 100 billion liras lodged in the bond market. That's staying in Turkey. So Turkish lira is stable. Maybe state banks are still supporting Turkish lira. I don't know. But I don't expect this equilibrium to continue simply because knowing Mr. Erdogan, I expect him to push for faster and deeper rate cuts as soon as the lira is stable. And as we have discussed, and the video is down somewhere here, in the previous episode of Real Turkey, political risks are mounting. A military incursion into Syria, S-400 issue, whether the presidential system will be amended, Ali Babacan and Professor Davutoglu emerging as challengers to Erdogan, so potential domestic political turmoil in the fall season. All of these things can overlap or juxtapose in September and October when Turkey's cash inflows are declining to upset the currency. And the fact is, Turkish corporate sector cannot handle another currency spasm or shock. And all of the calculations about inflation will go awry if we take another 10, 20% currency shock, even if it is temporary, because, every 10% weakening in the Turkish lira nowadays translates into 2%, maybe 2.5% pass through to CPI within the next 3 months. So, in other words, I really haven't changed my views that we're having a dead cat bounce, which is even weaker than I anticipated based on July data. I'm sure August is going to be somewhat better after such a massive rate cut. It would be impossible for things not to improve. But as of September, I think we're going to be faced with a recession again. And as the winter approaches, things will get from bad to worse. We stick to our forecast of 1.6% real GDP decline this year. I think IMF is somewhere around there too. Essentially, there is no one worthy of mentioning who believes Turkish economy is going to recover this year.
And along with further rate cuts, I think what this 425 basis points was a total of what the market was expecting before the change of the central bank governor. Now, as you said, given our president's character or his kind of greed on that inflation interest rate relationship, this kind of twisted relationship, I agree, he's going to be pushing for further rate cuts to a tune of 500 basis points, maybe. And while this 425 was okay with the market, given that Fed is easing, whether further steps will come or come not is to be debated. That European Central Bank is turning dovish, as given the consequences on its economic dynamics. Further rate cuts along the line in the winter times, or maybe in September. What are the risk factors that this rate cut can trigger? Where are we going to be seeing the hit coming from? Because as we've talked, the US and Turkish governments are in, let's say, constructive talks about delaying the problems or freezing the problems for the moment. What we're going to be seeing is perhaps some recovery on mortgage-related housing loans, given that rates are coming down. Maybe another inch of GDP growth will come from this hefty rate cuts, but we're rapidly moving into another danger zone because too much of rate cuts, and with the inflation outlook not really stabilized, that inflation expectations still moving in tandem what's happening on the currency front. What will be the triggers for another round of shock? That, well, as you mentioned, 10 to 15%.
Yeah, I think the first shock, of course, would be Fed not making a definitive commitment to further rate cuts after 31st of July. I think any improvement in the global economic data or even a temporary peace in trade wars, which would improve expectations and reduce the chances of ECB and Fed monetary easing, would be bad for emerging markets and would reflect poorly. Further rate cuts could perversely allow TL bond investors who feel they are stuck in Turkey to take profits and just get the hell out of Turkey. I know you don't agree, but an incursion into Syria or serious threats thereof or other political shocks could do it. But my biggest worry is the domestics. I mean, already they're buying to the tune of $1 billion a week, which is not changing the exchange rate level because we have a current account surplus. But we're almost in August. As of September, the tourists are going to leave. And as you said, even a slight recovery in domestic demand is going to lead to very rapid import growth simply because inventories are depleted, and even for basic domestic requirements, producers will have to import. So we could see a sudden shift in the current account balance, which could further spook both domestics and international investors. To be perfectly honest with you, each of these risks doesn't command a high probability, but as of September, I see a series of risks, the combination of which is very likely to upset this calmness in the foreign currency market.
And one last question. We know that our president is desperately seeking to get back onto growth path for Turkey. So he's aggressively playing with the monetary policy, with this strong, expected to get stronger rate cuts. But what about the fiscal side? Does he have any room to spend further to give cheap loans through state banks to support domestic demand that he used to do in the last 12, 18 months periods, which really resulted in a rapid deterioration on the fiscal side? Does he have that room? Or if he doesn't, is this the reason why he's really going for the monetary policy? Can he combine both? Can he convince the banks to lend more? Do the banks have any room to do such aggressive lending to Turkish corporates? And is there demand from the corporate side for such loans beyond restructuring their problematic loans?
Yeah, I think the fact that the fiscal lever has been fully used is why he is leaning so heavily on the monetary policy. Yesterday, Bloomberg published an article claiming that the Treasury will exceed its annual domestic borrowing program, probably to the tune of 10-15% or 10-12 billion liras. Turkish banks are tapped out. More Treasury borrowing immediately leads to crowding out, which means the private sector can't get loans. There is another problem here. Even with additional borrowing, the fiscal deficit is going to reach 4.5% of GDP, and is clearly unsustainable. To make any kind of improvement, to stabilize the current path of fiscal deficit, Turkey needs to raise electricity and gas prices, which is also a requirement to bail out, energy companies, which constitutes a major problem for bank balance sheets. But once you do that, of course, inflation goes up, and monetary policy become ineffective. Essentially, the fact that we need fiscal tightening makes any kind of monetary loosening ineffective. They sort of clash with each other, and the net effect is very small in terms of economy. I think Turkey has run out of both fiscal and monetary space simply because one doesn't have room to borrow, the other one doesn't have any credibility. Mr. Erdogan needs to understand that we need structural reforms, the most important of which is that he needs to establish a structure. We need to do something to solve the problem loans in the bank balance sheets. Neither the bank shareholders nor company bosses will put up new money knowing Mr. Erdogan actually will decide what to do with this money. So we need judicial reform and Mr. Erdogan devolving some authority to other ministers before something happens. To me, Turkish recession will not end before we call IMF to the rescue and sign a standby to at least reestablish credibility.
Thank you very much, Attila, for your contribution. So it seems beyond the summer months, as long as the government doesn't really need help or want to seek help from the IMF, Turkey is going to be seeking help from the outer space then, given that it's going to be a very tough winter season for the Turkish economy and politics as well. Hope to see you next week, everyone. Bye-bye.